Okay, good evening, ladies and gentlemen. You're very welcome to this evening's Cultivate Farm Structures and Succession webinar. This is the first webinar that Cultivate have done, so we're delighted to be here tonight. My name is David Leydon. I'm head of Food and AgriBusiness with ifac, and I'm delighted to be joined tonight by Finbarr, who's CEO of Bantry Credit Union and also chair of the marketing board of Cultivate, by Philip O'Connor, my own colleague in ifac, who's head of farm support, by Declan McEvoy, who's head of tax with ifac. Just want to point out, we welcome questions. There's plenty of question boxes there on Zoom, so we welcome questions throughout the night. And to begin with, I'm going to hand over to Finbarr to welcome everyone here tonight. So Finbarr.
Great. Thanks very much, David, and good evening, everybody, to this strange forum, but it was not even that strange anymore. We're all getting so used to it. We actually had our own AGM, Credit Union AGM last night, like this on a virtual platform. So yeah, it's to use that terrible cliche, the new normal. But anyway, down to business. I'm here representing Cultivate, and Cultivate is the farm loan offering of credit unions. The timing of the webinar is quite opportune and suits us very well, because there was an announcement today where the credit union family is extended, and as a result of 4 credit unions with about 12-14 offices in 3 new counties coming on board into Cultivate, from now Cultivate is available in 88 credit union offices across 13 counties, and there are plans underway for another 10 credit unions to onboard or to join in the coming year. But that said quickly, what I really want to say is tonight's not a promotional opportunity for credit unions. It's not a promotional opportunity for Cultivate. What tonight is it's a response to a need that the credit union loans officers really have been picking up on as we're dealing with farmers and as we're getting to know them a bit better. And what we're really getting a sense that the urgent need for succession planning in Irish farming, and the need for farmers we're interacting with and dealing with, for them to really think about what's the most suitable farm, the business structure for their farm. So when I was asking myself, why did Cultivate team up with ifac, to put this webinar together? And what I'm about to say can sound a bit kind of cliched or glib, but it really isn't. It simply is the truth that in credit unions or for credit unions, it's always about the people. It's always about our people. And so if this webinar helps in that way, that's us delivering on what we see as our mandate. So with that note, I'm going to hand back to you, David.
Finbarr, thanks very much. And you absolutely do believe that, there's no question about it. But to maybe set the scene for tonight's discussion, and we're going to have a discussion with Declan McEvoy in a couple of minutes about farm structures and about succession and the challenges. I'm going to ask Philip O'Connor just to share some of the insights from the recent ifac farm report, and it touches heavily onto the succession issue. So Philip, you might take it away there and share what we learned from the farm report.
Can you hear me okay there, David?
Yeah, you're perfect. Thank you.
Sure. Thank you very much, and thanks very much, Finbarr, for the opportunity for coming on tonight. As David said, we're not going to do that by PowerPoint, so literally I have 3 very quick slides, 5 minutes, just a quick little snapshot of our recent Irish farm report, where we asked farmers from north to south, east to west, what they thought, what was going on in the industry at the moment. So it's just a little snapshot. So I said I'd just pick out some of the more interesting stats of what's happening out there, and then I'll hand back to you, David. So I suppose, look, the first thing, and I suppose Finbarr did touch on it, the new normal. Yeah, so no surprise here that farmers have said as part of their business, 86% of them feel that broadband is crucial or vital to their business, and we're not surprised with that. Like, here we are on a webinar tonight, and even post-COVID, internet will be a vital part of our businesses, and that's not going to change. I suppose if you asked farmers a year ago, 18 months ago, would they buy and sell animals on lines? And no, they probably could. Most of them said no, they wouldn't. But look, when we asked the farmers now, after a year gone into it, would they like to see marathon lines continue post-COVID? And 70% of them said yes. So yeah, so there was a real appetite for that, and that was consistent across all the sectors. So it wasn't a case of that one sector was higher than the other, when it was consistent across when we asked the dairy farmers, the beef farmers, and the sheep farmers, ranged from about 68% to 73%. When we asked sort of technology what farmers are using, 1 and 2 were using herd or breeding software. So no surprise there. Like, I mean, there's a perception out there that farmers are not that tech savvy. They're actually using quite a lot of tech. And I say 1 and 2 of the farmers we asked were using some sort of breeding software. Succession then, I suppose, is a key one, and Declan will probably delve into these stats a little bit more when he's talking to you, to David. But like, it was very interesting, and like, we've done this stat for a few years now, like, and it's always a high stat, and that 71% of farmers haven't had a successor identified. And when we delved a little bit more into it, 1 in 3 of them were saying the reason they're struggling sometimes with this conversation is they feel the farm's not viable enough, so they're not quite sure to do it. And that's something that Declan and David will explore a little bit more. When we asked about, like, I mean, you look at environmental issues, a lot of talk about the national herd and what's going to happen and so forth. 84% of farmers plan to maintain or increase their stock over the next 3 years. So the farmers that we spoke to weren't looking at possibly getting rid of or downgrading their stock. They were going to keep them on. From an employer point of view, 21% have had labour out there, and of these, only 21% have written contracts. And look, that's something that's very important. It's something we do with our employer services within ifac to make sure that when our clients have employees, that all the correct stuff is in, all the correct documentation is in place. Another succession stat that came in here, and this is definitely something Declan would be shocked if he doesn't mention, is about the wills. 40% of people don't have a will. We were, I don't know, in one sense I was surprised and then I wasn't, but it was in the sense of, yeah, it's a very high stat. But then when I think about it, when you do talk to farmers, a lot of them don't have wills. And when I think of ourselves at home, and myself and my brother, neither of us have one. So unfortunately, I am one of those stats, but it is something very important. And it's something that I'm sure Declan will discuss a little bit. 20% of people said they found it very hard to get people with the right skills. So, like, I suppose labour, again, a little bit back into it, the labour shortage. When we looked at financial planning, like, and let's be honest, like any business, margin's important, making a profit, and they're getting tighter. So 3 in 5 farmers, we said, look, do you financial plan? Like, do you look at your figures and where they're going into the future? And 3 in 5 don't complete any budgets at all. We asked a little bit more again about future planning into the future and about pensions in life. We are going to wind down at some stage and hopefully retire and different things. So we asked our farmers how many of them would know what you would need to have 200 euros a week from the age of 65, and 3 out of 4 didn't. So if you were to have a 200 quid a week from the age of 65 for 20 odd years, what would you need in your pension pot? And 3 out of 4 didn't know. The actual answer is 300,000. We asked the sentiment survey, so this is something we always ask, what's their positivity in the sector, and 56% had a positive outlook in the sector, which was quite good. 81% of them said categorically they will definitely be farming in 5 years' time. And Brexit, I suppose, while we haven't seen the full impacts of Brexit probably quite yet, farmers are very, very wary of it. And it was no surprise that 95% of farmers said that it would have an impact to them, and only 5% said they don't. So, yeah, time will tell how the Brexit scenario will feed out over the next number of years. So, look, the full report, look, that's really a whistle-stop tour. I mean, like, the report there's a lot more detail in the report. There's a lot more articles and delving into different particular topics. There's a lot of, actually, there's a number of articles written by Declan and some of his team, even one written by yourself, David. So if anyone wants to download the report, they can go to the ifac website. But look, as I say, I've had 5 minutes, and I think I've kept it to 5, David. So thank you very much.
Well, Philip, I think it's one of the first times in your life you kept to 5 minutes. And to be honest with you, when you started mentioning Brexit, I was very tempted to mute you. So, but you had set the scene nicely. Lack of successors, no wills with 40% of people. Declan McEvoy, succession, complex topic, sensitive. Where do you start when you want to start that succession conversation? Do you start with tax?
Even though, you know, I'm head of tax, you shouldn't start with tax. Tax facilitates the process. It shouldn't drive it. You know, so hugely important from that point of view. And just to go back on Philip's stat there for a minute, you know, the 40% don't have a will. But look at the 60% who do have a will. You know, how old is the will? How up to date is it? They could actually be in a worse position than the 40% who don't have it, because it could be so out of date and doesn't reflect the needs of the family. So where I would say where you start in succession is, the first thing is, whether you do anything or not, you need a will and you need it up to date. That's the first thing. And review your will, you know, on an annual or a biannual basis, because a will speaks from the grave. Just because you draw up a will doesn't mean it's written in stone. You can opt to change it at any time or if circumstances change. But on it, you know, on succession, the key consideration to take into account is not the tax, first of all. The key consideration is, have you a successor? If you have a successor, engage with him, talk to him, know your expectations, know his expectations, know where the business, you know, he might have totally different ambitions for the farm business than you. And are you going to be happy with that when he succeeds to you? If you don't have a successor, all is not lost. The one thing that you have to keep in mind is, if you don't have a successor, that's where suddenly tax comes to the top of the agenda, because you have to make sure whatever you do doesn't rule you out of any of the allowances that are there in the future. So going back then with the successor, it's have this discussion with the successor. When you know where the successor is, have the discussion with the family. Bring in the family. Make sure that the family expectations can be met, because in a lot of cases, it's the successor who's going to have to pick up the bill to look after the family.
Declan, for the outgoing generation, for the older generation, what should they be thinking about? And what are they working?
Yeah, the first thing they have to think about is themselves. They have to think about security. They have to think about potential costs for themselves. You know, Fair Deal nursing home scheme, it's there at the moment. There's big changes about to take place. It has been passed by the Attorney General now to go back to Cabinet with big changes. So that has to be looked into. It also has to be looked into then from their own income point of view. Are they going to have enough to live on? People will not be able to survive just on the old age pension, with the cost of living, with running a car, with keeping a house. So is it possible that the farm can contribute something? It may not be possible. So that brings you back into, you know, as Philip was saying, the viability issue. Suddenly the farm may have to move to part-time farming, you know, for the next generation. So there's massive things that have to be looked. But, you know, to sum it up, you have to be selfish, first of all. You look after yourself and then you look after everyone else.
Okay. For the people that are, and for the generation that's taken over, be it a son or daughter, be it split or be it whatever way they're going to divide up the farm, or not divide the farm, or divide the various assets that they have, what are the key considerations for that incoming generation?
Well, as I was just, you know, briefly mentioned, the key considerations are, number one, look at the overall farm, look at the profitability of the farm. If the farm is making 40 or 50,000 euros and the transferor has an expectation to get 20 or 25 out of it, and the successor is looking to get 30 or 40 out of it, the pie is not big enough to go around. So the first thing is look at the pie, look what's in it, and that, see what can be done. The second thing then is to look within the farm then, is there changes needed to the farm? Maybe the next generation thinks that the farm is not being operated at its maximum capacity. Does the transferor, would they be happy with that? Now, must remember the transferor will be stepping out. So, you know, need to consult with them. The next one then is look at other family members and look at their expectations. I have seen it happen that the expectations of other family members are so big that suddenly it makes the successor taking over the farm, their job, impossible. And at that stage then, they may have to say it's not worth it taking it over. That can create a completely different problem. But by having those and putting all those on the table, you end up having a family discussion. And by having the family discussion, you know, it can solve problems, it gets rid of tensions, gets rid of problems. It can also highlight problems that you may need to go and get mediation on and that type of thing. But better to have those problems identified day one before you transfer.
Declan, those conversations around the kitchen table, if they happen, and a lot of the cases they don't happen, are loaded with emotion, maybe gaps in people's expectations. Should families look at outside facilitation of those conversations, a bit like some SMEs would look for outside facilitation? Because even if it's a smaller farm, it's still a reasonable asset.
If there's conflict or potential for conflict, it shouldn't get personal between people. So of course they should look for outside expertise. And you must remember that mediation is taking the views of both sides on board, and it's not coming down in favor of one side or the other, and is trying to mediate a common goal between everyone. So it's to try and take the conflict out of it, and it's better off to take that conflict earlier. The other side that's in it is that sometimes you may better off to keep professional advisors out of it at that stage, until you actually get comfortable. You know, look, the easy one is the one that where there's 100% agreement between the transferor, the transferee, and the family. That's simple to deal with. And that will be in the vast majority of cases. But it's those cases then that there is the potential for conflict, or expectations can't be met, and that, you know, between everyone, bring in mediation, have discussions and that type of thing, and take the personalities out of it.
Okay, I just want to go back to one thing, which is the no successor issue and how stressful that is. And in many cases, farm families have educated their sons and daughters so well that they've left the farm, they've travelled to the bright lights, and in many cases, they're not going to come back to run a suckler farm with 10 or 15 cows like maybe their dad did. A lot of Cultivate customers and members are, you know, in the sort of part-time beef and sheep end of the business. So for those farm families who have educated their sons and daughters to travel the world and to leave the farm and not come back, you said there are options. What are those options?
Yeah, there's big options. You know, back a number of years ago, the only option was the early retirement scheme, where the parents stood back from the farm and leased out the farm or gave it to a son or daughter. That early retirement scheme was so restrictive that even though it was advantageous on one side, it was major disadvantageous on the other side. But the options are, today we have, you know, you lease out the land, but you have partnerships, you have share farming, you have different types of arrangements that you can enter into arrangements with other farmers, you know, to keep the land being farmed. Because maybe today that person, son or daughter, doesn't want to come home to farm. The pandemic and COVID has shown us that suddenly rural Ireland is a different place in 2021 than even where it was a year ago. It's now attractive to live in rural Ireland. And with, you know, technology, which we're using here tonight, work from home is a big thing, and blended work is going to be possible into the future. So that's where it opens up the possibility of entering into a partnership in the medium term with keeping the door open for someone to come home and farm part-time. And there's loads of suites or reliefs available for them to help them on those type of things.
Okay, let's just, we've moved on from, we'll say, the conversation now, and there is a plan in place within the family as to how the farm is going to transfer to the next generation. What are the taxes involved and what are the reliefs involved?
Well, farming is lucky from the point of view is there's a suite of reliefs available within farming that, if it's properly planned, capital taxes, which it's called on transfers, shouldn't be an issue. Even though incomes may be a problem on farms, and income may be small, you know, in the sector that we're looking at mainly, and that the vast majority of people still have a very valuable asset. If you even only have 60, 70 acres, you could be looking at an asset of value anywhere from 600,000 to €1 million. And if you don't plan properly, €1 million worth of property could have significant tax hit. So when you look at taxes on a lifetime transfer, you're looking at stamp duty, which is stamp duty on the deed transferring it. You're looking, and the stamp duty of a young trained farmer can have 0 stamp duty. A blood relative can have 1% stamp duty. And if it's a stranger, it's 7.5% stamp duty. So you transferring to a stranger, you know, non-blood relative, it's 75,000 in a million. It's 0 to a child. So there's the benefit, under 35. If your child is over 35, it can be 1%. You've gift tax, which is by the person receiving it. But again, there's loads of reliefs. You'll hear agricultural relief, business relief and that. But loads of reliefs there if planned for, and capital gains tax as well for the transferor. And that's the one that people find it hard to get their head around, capital gains tax, because you're giving away something and you could be liable for capital gains tax if you don't meet conditions. And the big trap in capital gains tax is where property is jointly owned between husband and wife. Both must meet the conditions of it. And it's the both with the conditions, and the biggest condition is that both must have farmed it. You know, so even though it might be in 2 names, one person might only have farmed it. So there's massive reliefs available, and you could transfer effectively over 3 million worth of property without any tax. So if we're looking at property with 1 million, properly planned, properly thought out, could lead to little or no tax.
Declan, that is your mantra, you know, that planning piece. What type of time frame should people be thinking about when they want to put together a very good tax efficient plan for us in a succession case?
A minimum of 12 months. A minimum of 12 months.
Yeah.
In the back when we used to have budgets in December, and that's only back 3 or 4 years ago, there was panic coming up to the budget to get stuff transferred before the budget and that type of thing. You know, and people would come in today with the budget being on Monday or Tuesday. I want to transfer the farm with little or no thought process. You're transferring an asset with value. You have to look after yourself. So a minimum of 12 months. I'm dealing with a case at the moment where we're planning for a 5 to a 7 year exit. So bringing in the son nowadays as a partner. He has been an employee for the last 3 years. Now going to bring him in as a partner for the next couple of years, ratchet up his partnership share over a couple of years, and then ultimately transfer. You know, so that's extremely good planning. Now that's the rarity.
Yeah.
But a minimum of 12 months if it was perfect, it'd be 3 odd years to talk about it, know where everything's going, make sure everyone's happy. Because for the transferor, it's a big decision, you know, just to hand away a lot of it.
Okay. The tax is complex. We're not doing PowerPoint tonight, so we'll move from that piece and we'll just talk about maybe the most difficult issues you come up against on a day-to-day basis, because you're dealing with this every day.
Yeah, they outside the emotion and the family issues that I come up against, you know, where there's unreal expectations, is lack of proper planning. A basic one, and I quote it the whole time, is a site to a son or daughter. Normally what happens is a farm is transferred on with an express wish of, like David, you know, if your brother or sister wants a site, give it to them. Parent giving a site to a child, no tax. Brother or sister giving it, tax.
Oh.
Little things like that. That's one example. Second example then is stamp duty. If you have to be under 35 to get away with stamp duty, people think it's 35 years of age. So you're in your 35th year.
Yeah.
And that's one, because if you get that wrong, you're looking at $1 million worth of property. Even 1% is 10,000. So if that goes up. And the third one then that comes up the whole time, third and fourth, is the joint ownership becoming an issue. Not that much of an issue between husband and wife because you can plan for it. But say 2 brothers owning land, one married, one not married, and giving it to son / nephew, problems around it. And the other one then that comes up is the son or daughter not qualifying for the reliefs, making assumptions that they qualify for the reliefs and not qualifying for them, which leads to problems.
Okay. Declan, we're touching off 8 o'clock. We've got 20 minutes to go, so I'm going to pause that there now. The 3 things I've taken from this conversation is you need to have the conversation, number one. You need to put a bit of planning in place, give yourself 3 years ideally, and you need to have an up-to-date well. They're three pretty fundamentals. But we'll move on now to structures. And farm structures have been evolving. It's not simply sole trader anymore. But maybe to begin with, you might just outline in very broad terms the most common farm structures that are available. And then we'll dig into, the pros and cons of each of the farm structures and why you should actually move into one or the other. So broadly, what are the main farm structures that are available?
The main ones that are available is sole trader, which is the individual, farming. The second one then is, and it's very common, is partnerships. But even when you come into partnerships, there's a subdivision of partnerships. There's an informal partnership, there's a financial partnership, there's a registered farm partnership, and there's a succession partnership. And as you move up along from the informal to the succession, it gets more complex because it's more legalistic. Subdivisions of partnerships and sole trader are share farming, share milking arrangements, cow leasing, all those type of things. And then you move on to the one that's the buzz out there from a tax saving point of view is limited companies, because excess or retained profits are taxed at 12.5%. But as you move along, that's where it is. And limited companies a lot of people rule them out, but limited companies have a place even if someone is part-time farming and there's off-farm income. But the most common one is sole trader, the individual farming.
And before we get into that, you mentioned share farming, share milking, and cow leasing. Just give us a feel for top line, what's share farming and what's share milking?
Yeah, and I'll start with cow leasing. So what cow leasing is, as it is what it says on the tin, leasing out cows. So you're a dairy farmer and you have excess stock. You can lease out those stock and it's still treated as part of the farming trade. But you're a non-dairy farmer and your thing is buying in dairy cows and leasing them out. That's a trade in its own right, separate to farming. It's a service. There can be VAT issues around cow leasing, and that it's mainly the bigger guys and the bigger people are doing cow leasing. Share farming is two farmers sharing the workload and sharing their farms, but it's each of them farming separately. So David and Declan go into share farming. I could be a dry stock farmer and you're a dairy farmer, David. You still remain dairy farming. I still remain dry stock farming, but we could be sharing the inputs. You could be putting your replacements onto my farm now, and I could be helping you do the milking and that type. It's not quite a partnership because each of us keep our own accounts and we keep them separate from each other. We have our own bills. And share milking is an evolution of that, where the milk check is split between two farmers. Yeah. So we have a milk check coming in for the peak months of 10,000 a month, and just say we've total milk sales in the year of 100,000, and we're in a share milking arrangement that we've agreed to split at 60-40. So you get 60% of the milk check, I get 40%. We've agreed to pick up the expenses in a certain way. It's a formalized agreement. Each farm can be looked at separately. One of the big advantages of that is if you were in dairying and I'm not, you don't have to register for VAT, and I could if I wanted to. So we could have two businesses, one registered for VAT and one not.
Right. And Lachlan is going to put it up there now, but there's the Cultivate review is a report we put out every year for Cultivate, and it shows that about 25% of the people who use Cultivate are dairy farmers, but the rest are in the beef and sheep game. So probably the sole trader is the most applicable to that group, despite there being some exceptions. So let's just talk about the sole trader, the benefits and the downsides of being a sole trader farmer.
Well, the first thing is sole trader is you are farming as an individual. So whatever you make is your own. After you pay the tax liability and that, it's personal money. So it's your money to do what you want with once you have actually paid the tax. It's the simplicity of the structure is, everyone is doing it, or most people are doing it at the start. You're filling out the basic payment in your own name, the herd numbers in your own name, the bank account is in your own name, you take out a loan, it's in your own name. It's you as an individual dealing with everything got to do with the business. The downside of it is, though, that if you have a very big profit in a particular year, the tax liability, it's very hard to shelter it post the year end, where you'd have to be planning, you know, within the year to try and do something of it. So the big disadvantage of the sole trader is the unexpected happening. That's the big disadvantage. Very hard to control tax, and people can get upset by suddenly a very big tax bill coming.
I'd say you've experienced that now and again.
I have, yeah, a lot. When I was dealing with compliance, a lot. Lucky I don't deal with that much of it, but I get brought in on it. And, you know, sometimes people need to stand back and look at the business. Because if you look at the business and, you know, if we look at the outlook for 2021 is quite good in farming at the moment. So if you look at it and you're able to reduce bills in the year, you know, say reduce creditor balances in the year, you might be able to spend a bit of money on the farm and you might be able to have some reserves at the end of the year. That's an indication before you go into your accountant that it has been a good year. So, you know, there's more money there. That's going to mean more tax. You may be able to shelter it with income averaging or some of the on farm. But if you don't do something in the year to shelter it, you're looking at pensions post year end. Harder to shelter it than any of the other structures.
Okay. So just to remind people, please add your questions to the Q&A. Make them as complex as you want and throw them in there now, and we'll discuss them with Declan at the end. I see there's 3 questions in already that we'll get to at the end. So, Declan, when people are thinking of changing from a sole trader, what's the motivation? What's driving them?
You wouldn't believe it, but tax is not the first motivator.
Right.
It's normally because, you know, there's something other. The biggest motivator for moving from sole trader to partnership is the grants that can be available for it. There's a collaborative farming grant available from the Department of Agriculture to set up a registered farm partnership. So registered farm partnership can be a stepping stone to succession, can be a stepping stone to other things as well. But the main driver of changing structure is normally grants. And of all sectors of the economy, farmers are probably the best sector to look at grants and look at drawing grants. I don't think there ever has been a grant that has been undersubscribed. It's the other way, oversubscribed. And it's mainly TAMS grant. Look at it at the moment, slurry equipment, look at it, fertilizer spreaders, look at it, GPS. If you want to do buildings and that, there's grants available for it. And by going into a partnership, the ceiling can increase for grants from 40% of 80,000 to 40% of 160,000. And if you have brought in a young farmer who meets all the criteria, they can get 60%, you 40%. So there is a 50% grant of 160,000, 80,000 of a potential grant in. So if you were doing buildings and that met all the conditions, you could effectively be spending 160,000 and it only costing you 80,000 euro. That's the single biggest driver. And over the last couple of years, is, you know, with the, as I said, the slurry equipment, the GPS, fertilizer spreaders, everything coming in, that has been the single biggest driver. Then income tax will be a driver, you know, because suddenly the son or daughter may only have been in for a nominal wage on the farm. You must remember that a single person can earn 34,000 at the low rate. So if the parents are at home and there's no off-farm income there, between the 3 of them, they can earn 100,000 euro at the low rate of tax. So that should be maximized. That's the driver of it. And in a lot of cases, it's succession drives it, that it's a stepping stone for succession. And it's like someone having to go through a test. You know, the parent or the father in the vast majority of cases is testing out, is the person suitable or not for the farm business.
Does it add many tax issues or tax complexity to to a farmer's life, we call it, when he moves from sole trader to partnership?
Not from a Department of Agriculture regulation point. Once you get over the initial setup, like anything and like any change, the initial setup can be complex, a lot of paperwork involved. But once you get up and running, you're okay in it. Because, and even look at the changeover, you know, back in 15 from a single farm payment to basic payment. You know, complex in the first year because you had to have everything right. You had an allocation right, you had to activate it. But once you got up and running, it was it. The change from sole trader to partnership, in doing it, a huge amount of paperwork in it.
Right.
And depending on which partnership you're in, you know, the level of paperwork moves up along. But once you've got over the initial hurdle, there's no issue whatsoever. And there's opportunities within partnerships that are not there within sole traders. You know, there's a special stock relief there for registered partnerships. There's the grant available, you know, so it gets up and running, you know, without any difficulty.
Okay, well, the number of questions are popping up. So we'll keep going, Declan, and then we'll get to the questions. Limited companies, not just for big dairy farmers that some people might think.
No, because the myth out there is the limited companies are only for the guys with super profits. It's not. Because if you have off-farm income, you could suddenly have a small farm profit, let it be 10, 15,000, 20,000, that could suddenly be liable at 52% rate of tax. So if you don't need that money to live on and you want that money to go back into the farm, you look at 20,000 at 52%. Is 10,400. 20,000 at 12.5% is 2,500. So there's 8,000, and even take out the extra costs of accounts, there's the guts of 7,000 available to go back into the farm. In 1 year, you know, people dismiss it. Oh, it's only 7,000. That's 1 year. 5 years is 35,000. 10 years is 70,000. So if I said to someone, I can give you an extra cash injection of 7,000 a year into the farm on it, would you take it? Of course you would.
You need a lot of
fertilizer,
a lot of reseeding to make that happen.
No, and that's where I'm coming at, David. The inputs. If someone said we can reduce your input costs by 7,000, anyone would jump at it. And what it doesn't improve profitability, but it improves the amount of cash that's retained within the business.
Declan, like 90% of the Cultivate beef farmers who have taken out a loan from Cultivate, 90% of them have off-farm income. So this limited company may be suitable, and it's definitely not something to just throw aside and say that's for the big dairy guy, because it actually has a role within certainly the part-time beef farmer at certain times. The benefits and downsides of going into a company. So you're saving the tax for a few years, but there has to be downsides.
Of course there's downsides, yeah. But once people are aware of the downsides, you know, they're not a major issue. It's very rare that the land will actually end up being in the limited company. The land will be owned by yourself and leased in or rented into the company. So at that stage, what's in the company is their stock and machinery are the main items that are within the company. The big advantage, as I said, is the tax. The second, their big disadvantage is that cash can get trapped within the company. So suddenly you may have cash within the company and you need cash to do something personally and that type of thing. At that stage, you may have to take a hit and pay the income tax on it. But it has given you the chance to build up that money over a number of years. The big advantage within the company structure is it gives the opportunity to build up that money and access it in a tax efficient manner. You know, should you be standing back from the farm at some stage in the future, passing it over to the next generation. The company is more complex to operate. But again, like anything, it's new. Once you get up and running, you can get over the hurdles. You must remember the company money is not your money, it's the company money. But that's why you set up what's known as a director's loan at the start, which is you're selling in the stock and machinery effectively. So the company owes you that money. So the minute the company pays its 12.5%, you can draw out that money. So it's capital that you have built up in the farm can be released back to you.
Yeah, so the director's loan, I think it's pretty critical. Just here
Yes.
from Sandra, and you mightn't be able to answer this, but what is the cost of doing accounts for a limited company, and is there a minimum turnover?
No minimum turnover for a limited company. And a limited company doesn't have to register for VAT in farming. It's treated the same as any. It's very hard to answer the question, and I'm not dodging it. How much is a set of accounts? Because it depends on how complex it is, how big it is. I would deal with companies that are quite small, that are way more complex than, you know, companies that are quite big. I'm dealing with a company at the moment where there's a lot of land in the company. It's not very profitable, but we have huge succession issues around it. So way more complex than someone just on a straight form or on a straightforward, you know, limited company.
Good question in here from a man from Monaghan called Fergal. Can the limited company then legally pay the retiree to work on the farm?
Of course it can, yeah, because they can become an employee. You know, under the old farm retirement scheme, you couldn't work. That scheme is gone, so you can work on the farm. You can start being a director and shareholder and work on the farm as an ordinary employee.
Okay, I hope that answers your question, Fergal. What stamp is a limited company? In a limited company, how do you deal with farm buildings? I think this hits on the director's loan, I think, doesn't it?
Ask me that again.
In a limited company, how do you deal with farm buildings?
Well, see, the company can erect farm buildings. So if they're brand new farm buildings, the company can erect them. And the lease would always allow a building to be erected and that on it. The existing farm buildings would not be transferred into the limited company, and you may lose capital allowances on them. You can transfer them in. It's complex. It's the single most complex issue is the transfer of farm buildings in. Because if you're only after doing brand new buildings or that type of thing, and then you're looking to go into a company, it may not make sense to actually go in just as a straightforward. It's something we're not going to touch on in detail is a hybrid structure, which is a company involved in a partnership. That can get around it. But farm buildings is the single most difficult problem to deal with.
Okay, and Lorcan is going to share that structure booklet again there because it deals with the hybrid structures. Okay, I'm going to kick into a few of these key questions. From Imelda, with regard to land in joint names, husband and wife, what criteria is required to prove that the wife is involved in running the farm?
The single biggest criteria is the ability to enter into contracts on behalf of the farm.
Yeah.
So that means if the land is in joint names, that she was a joint borrower if there was borrowings, that they're on the current account together, that they sign checks, that she's involved in the farm business. It's a matter, it's not one thing on its own, it's a matter of building the story and accumulating all the information. Back some years ago, joint herd numbers wasn't a possibility, so that wasn't there. But if all of those are there, it's a matter of building it. The bank account, I would say, is the single biggest factor. If the farm bank account is in one name, it's going to be very hard to prove it.
Okay, hope that answers your question, Imelda. Anne Mitchell, what stamp duty is paid on a gift of a site to a niece or a nephew?
What stamp duty?
Yeah.
Yeah, stamp duty is paid. A site is 7.5% with an 11/15 payback when they build a house on it within 24 or 30 months. But it's not 1%, it's 7.5%.
Okay. Declan, the next one in from Kenneth. Can a limited company join an existing registered farm partnership which has high profits in order to reduce the partner's personal tax liability, and will revenue challenge such a scheme?
Well, to start with the last part, will revenue challenge such a structure? There has to be commerciality within it. Outside just tax saving, there has to be commerciality. And the second thing is, yes, a limited company can join an existing registered partnership. However, it's not just as easy as joining it. There's certain Department of Agri rules that they have to meet, And if you don't get over that bar to meet those Department of Agri rules, it can't join it.
Okay. That definitely is a more complex one to deal with. Is stamp duty, from John here, is stamp duty exemption still in place if resident on farm with relative? Does that make sense to you? Maybe we need a bit more explanation from John.
Yeah, no, just get a bit of clarification on that. Yeah.
Little bit more clarification there, John. Type it in. Two questions came in during the week. The first one is, and you've seen these earlier, to ensure that the landlord continues to qualify for retirement relief from CGT on the future transfer of the farm, does the landlord, as the leaser of the long-term lease, have to obtain a stamp duty certificate from revenue? If not, how does the landlord ensure that this criteria for qualifying lease is satisfied? That
Well, you see,
sounds like it's coming from another accountant.
Yeah, but it depends on who the landlord is. If it's father to son, the thing about it is there's no requirement there for a valid lease to be in place, father to son. But if it's uncle or aunt to niece or nephew, yes, there's a valid lease requirement. And to have a valid lease, the lease must be stamped. So the proof is to have a stamped lease in place. And the second part of it, if not, how does the landlord lessor ensure that the criteria for qualifying lease is satisfied? In all cases, it's the taxpayer or taxpayers who have the onus of proof on them, not with revenue. The simplest way to have it is have the lease stamped. And if lease is at market value, there's no stamp duty on agricultural land leases.
Okay. Thanks for that, Declan. Another quite long one here. Farmer who's operated as a sole trader for 30 plus years enters into a partnership with his son as at the 1st of January 2020. Is this a cessation of trade for the sole trader under case 1 and commencement of a new trade under the partnership? And the sole trader is operating income averaging.
Yeah, there's two parts to that. So the first part of it is under normal cessation rules. Yes, it is a cessation of a sole trade. But if they're going into a registered farm partnership, income averaging is deemed to continue. But if they're going into a non-registered partnership, income averaging ceases. So the second part of it is there any implications for this, and must he continue to be on averaging? That is, if it's a registered partnership, the father in that case would have to remain on averaging. The son doesn't have to remain on averaging because he hasn't been on averaging before. The son has a commencement in his own right. But the father has a cessation in one way and a commencement in the other. And those figures, if it's a registered partnership, are put into the averaging calculation.
Okay. Mary is 57 and self-employed. She works on the farm with her dad, but she has no farming qualification. Should she wait to transfer till after death?
Not necessarily. You don't have to have a farming qualification to take over the farm. The farming qualification can have an implication for farm grants, because what it'll do is it will give you a 60% grant if you're a young farmer as against a 40% grant. But for stamp duty relief, if you're going to spend 50% of your time farming, and 50% of your time farming is 20 hours a week, and 20 hours does not mean a physical 20 hours out on the farm. It includes attending a webinar like this, doing banking, doing the business of the farm. So it's not that difficult on a farm to get 20 hours. Even on a small dry stock farm, anyone could get 20 hours, looking at grass, looking at fences, everything like that. So you don't have to wait to transfer.
Okay. Anonymous attendee, how would a son's new house built on the farm with a mortgage be treated for the farmer test for ag relief?
It's a non-farm asset day one. So it's the value of the house plus the site minus the mortgage will be taken into account because it's land that has been separated from the farm.
Okay, keep the questions coming, folks. We have another one here from Seamus, and we'll stay going until the questions dry up. From Seamus, if you set up a company, can you transfer, and this harks back to a previous question, so if you set up a company, can you transfer the farm buildings into the company and keep claiming capital allowances? And if not, why not?
Yeah, you can transfer the buildings into the company. and you stand in, the company stands into the individual shoes for the remaining life of those allowances. So if there's 4 years left on it, there's 4 years left. But capital allowances are not the issue. Even though farmers are not registered for VAT, under VAT rules that are there, a building is deemed to be new for 5 years from the day it's erected. And there's massively complex VAT rules around it. And it's the VAT that needs to be looked at, not the capital allowances.
Okay. If a farmer converts to a limited company, does he need to hold the company for 10 years before transferring to successor to avail of all tax reliefs?
Yes and no. Yes, if he's under 55 and he wants to get over 55 and pay no tax, with the exception of 1% stamp duty. But it doesn't stop him transferring at any stage. If he transfers within the first 3 years, capital gains tax on the transfer is 33%. If he transfers between year 3 and year 10, capital gains tax on any uplift is 10%. And if he holds it for 10 years and he's over 55, he can avail of all reliefs. But one must remember that the transfer of a company itself is liable for 1% stamp duty. Young trained farmer relief does not apply to the company. So if there was 500,000 worth of assets in the company between stock, machinery, farm buildings at that stage, it's 1% stamp duty that will be payable.
Okay, we're going to go back to John's question. So he's added a little bit of context. So hopefully, John, I get this right. What I think John is asking is there stamp duty exemption still in place if he is living on the farm with a relative for 5 years?
No.
And he's going to get the place?
No.
Okay, hopefully that answers it, John, for you.
Stamp duty is a tax on a document. And in order to get stamp duty relief, there's 2 reliefs. Number one, you're over 35 and you're a blood relative. It's 1% stamp duty at that stage. Number 2 is if you're able to qualify for favoured niece or nephew, you'll be treated the same as a child. But number 3, it's the big one. If you're under 35 years of age, you don't have to have lived for 5 years. The relief that John is talking about is probably business relief. Business relief is you have to be involved in the business for 5 years to get relief. But on stamp duty, there's none of those there.
Okay, we've no further questions, so we're going to wrap up now. And if there's any final questions that pop in, we will answer them. So you have about 3 or 4 seconds to get the questions in. Just firstly, like to thank Cultivate. John says thanks, so obviously we got it right, Declan, so thanks for that. We'd like to thank Cultivate for the opportunity for hosting this webinar tonight. It's something in ifac we're very passionate about because succession is such a challenge and it's such an issue for so many people. And also a lot of people and farmers aren't as aware of some of the structures that are available to them to minimize tax and to help with succession. So thanks very much to Cultivate. You'll receive a publication with both the Cultivate and ifac documents that we referenced tonight and publications that we referenced tonight tomorrow. If you want to see where the Cultivate offices are around the country, and you might have seen it today in the Examiner or the AgriLand or the Farmers Journal, there's nearly close to 90 offices around the country doing Cultivate loans now, and it's going to keep growing. So go to cultivate-cu.ie or visit your local credit union. And look, we hope the webinar gave you lots of, food for thought. Enjoy the rest of your evening, and good night.